An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match, rather than exceed, the performance of an underlying index such as the S&P 500. A growing number of investors have adopted passive investing strategies because one of their main strengths is the low fees that they charge relative to those of active investment funds. Index funds are generally considered ideal core portfolio holdings for retirement accounts, with legendary investor Warren Buffett recommending index funds as a haven for savings for the later in life. Rather than picking out individual stocks for investment, he has said, it makes more sense for the average investor to buy all the S&P 500 companies at the low cost an index fund offers. Instead of a fund portfolio manager actively stock picking and market timing, the fund manager builds a portfolio whose holdings mirror the securities of a particular index. The idea is that by mimicking the profile of the index, the fund will match its performance as well. There is an index and an index fund for nearly every financial market in existence. In the United States, the most popular index fund to track is the S&P 500, but there are several other indexes that are widely used, such as the Nasdaq Composite, consisting of 3,000 stocks listed on the Nasdaq exchange, and the Dow Jones Industrial Average, DJIA, consisting of 30 richest companies in the United States. An index fund tracking the DJIA, for example, would invest in the same 30 large and publicly owned companies that comprise that index. Portfolios of index funds only change substantially when their benchmark indexes change. If the fund is following a weighted index, its managers may periodically rebalance the percentage of different securities to reflect the weight of their presence in the benchmark. Weighting is a method that balances out the influence of any single holding in an index or a portfolio. Many index ETFs replicate market indexes in much the same way index mutual funds do, and they may be more liquid or cost-effective for some investors. One primary advantage that index funds have over their actively managed counterparts is the lower management expense ratio. This is because index fund managers are simply replicating the performance of a benchmark index. They do not need the services of research analysts and others that assist in the stock selection process. Managers of index funds trade holdings less often, incurring fewer transaction fees and commissions. In contrast, actively managed funds have larger staffs and conduct more transactions, driving up the cost of doing business. The extra costs of fund management are reflected in the fund's expense ratio and get passed on to investors. As a result, cheap index funds often cost less than 1%, typically 0.2% to 0.5%. With some firms offering even lower expense ratios, compared with the typically 1% to 2.5% of actively managed funds. Expense ratios directly impact the overall performance of a fund. For example, actively managed funds, with their often higher expense ratios, are automatically at a disadvantage to index funds, and struggle to keep up with their benchmarks in terms of overall return. If you have an online brokerage account, check its mutual fund or ETF screener to see which index funds are available to you. Lowered expense leads to better performance. Advocates argue that passive funds have been successful in outperforming most actively managed mutual funds. Most mutual funds do fail to beat their benchmark or broad market indexes. For instance, during the 5-year period ending December 31, 2020, approximately 75% of large-cap U.S. funds generated a return less than that of the S&P 500, according to SPIVA scorecard data from S&P Dow Jones Indices. On the other hand, passively managed funds do not attempt to beat the market. Their strategy instead seeks to match the overall risk and return of the market. In the theory that the market always wins, passive management leading to positive performance tends to be true over the long term. With shorter time spans, active mutual funds do better. The SPIVA scorecard indicates that in a span of 1 year, only about 60% of large-cap mutual funds underperformed the S&P 500. In other words, approximately 2/5 of them beat it in the short term, although, in other categories, actively managed money rules. As an example, over 86% of mid-cap mutual funds beat their S&P Mid-Cap 400 Growth Index benchmark in a year. Index funds may also be structured as exchange-traded funds, ETFs. These products are essentially portfolios of stocks that are managed by a professional financial firm, in which each share represents a small ownership stake in the entire portfolio. For index funds, the goal of the financial firm is not to outperform the underlying index but simply to match its performance. If, for example, a particular stock makes up 1% of the index, then the firm managing the index fund will seek to mimic that same composition by making 1% of its portfolio consist of that stock. Index funds have been around since the 1970s. The popularity of passive investing, the appeal of low fees, and a long-running bull market have combined to send them soaring in the 2010s. In 2020, according to Morningstar Research, investors poured more than $400 billion into index funds across all asset classes. For the same period, actively managed funds experienced $188 billion in outflows. The one fund that started it all, the Vanguard 500 Index Fund, was founded by John Bogle in 1976 and remains one of the best for its overall long-term performance with low cost. The Vanguard 500 has tracked the S&P 500 faithfully in composition and performance. For example, its Admiral shares posted an average annual return of 7.84% versus the index's 7.86% as of June 2021. The expense ratio is 0.04%, and its minimum investment is $3,000.